The market feels frozen, but the numbers are finally starting to move. Mortgage payments are slightly less punishing, yet no one seems to be buying. So, is 2026 the year the housing gridlock finally breaks? Or is this just another cruel mirage for anyone trying to get a deal? Welcome back to Winds of Thought. I'm your host, and today we're cutting through the noise to look at the cold, hard data on the 2026 housing market. If you've been wondering whether you should finally pull the trigger on a purchase or hold onto your cash a little longer, stick with me. First, let's look at the rates. We've seen a stabilization that hasn't happened in years. But while the numbers are lower, the psychology of the buyer is still cautious. Inventory is the second piece of the puzzle. New builds are finally hitting the market at a rate that matches demand, but existing homeowners are still locked in to their older, lower rates. This creates a strange equilibrium. We aren't seeing a crash, but we are seeing a shift from a seller's market to a more neutral environment. However, location matters more than ever. While the coasts remain stagnant, we're seeing explosive growth in the Sun Belt and tech hubs in the Midwest. Inflation is cooling, but the cost of living remains high. Many prospective buyers are finding that even with lower rates, their debt-to-income ratio is the real barrier. For first-time buyers, the hurdle isn't just the monthly payment, it's the down payment. In 2026, the average down payment has reached an all-time high. The good news? Institutional investors are pulling back. They're finding better returns elsewhere, which is finally leaving some room for the average family to compete. Because of this, we're seeing a renovation revolution. People are buying older, more affordable homes and putting in the sweat equity to build value. The rental market is also exerting pressure. With apartment supply peaking, many would-be buyers are choosing to sign another lease while they wait for rates to drop further. Most economists agree, 2026 is a transition year. The frenzy of the pandemic years is gone, and we're returning to a more traditional, slower-moving market. If you're planning to buy, your credit score is your most powerful tool right now. Lenders are being more selective than ever, and a few points can save you thousands. Negotiation power has returned to the buyer. We're seeing more contingencies being accepted and sellers covering closing costs to get deals done. But don't forget the hidden costs. Property taxes and insurance premiums are rising faster than home values in many states, especially in disaster-prone areas. Technology is also changing the game. Virtual tours and AI-driven appraisals are making the process faster, but they can't replace a thorough physical inspection. The biggest mistake you can make is trying to perfectly time the bottom. The bottom is only visible in the rearview mirror. Focus on your personal timeline instead. Are you financially ready? If you have a stable income, low debt, and a 5-year horizon, 2026 might be the right time to stop waiting on the sidelines. The gridlock is breaking, but it's a slow process. 2026 won't be a gold rush, but it will be a year of opportunity for those who have done their homework. If you found this data helpful, make sure to hit that subscribe button. We'll be tracking these numbers every month to help you navigate the 2026 market. Thanks for watching Winds of Thought. I'm your host, and I'll see you in the next deep dive. What are your thoughts on the 2026 market? Let us know in the comments below. The 2026 housing market is at a crossroads. After years of volatility, we're finally seeing a shift towards stability. But for many, it still feels like a puzzle. Let's dive deep into why. First, let's talk about the one thing that's actually getting better: the cost of borrowing. After a brutal couple of years, mortgage rates have slipped back into the high 5% to low 6% range for many qualified buyers. This isn't a huge drop, but it shaves real money off monthly payments. It's the difference between affording a new car payment or not for the average family. But if buying is technically getting cheaper, why does the market still feel so empty? The answer lies in the inventory paradox. Even as rates dip, the supply remains tight. Many sellers are still locked in to ultra-low rates from years ago, hesitant to move. However, we're seeing a 10% year-over-year increase in national inventory. New listings are finally surging, offering more options than we've seen in years. Then there's the question of price. Are we finally seeing a cool down? National house price appreciation has slowed to its softest pace since 2012. While the Sun Belt sees a surplus, the Northeast remains a seller's stronghold. In 2026, prices are expected to stall or grow modestly, aligning with inflation. Buyer sentiment is lagging behind the data. Caution is the word of the year. Wages are now growing faster than home prices, a critical turning point for affordability. Families are no longer rushing. They're waiting for the right home at the right price. So, what's the verdict for the 2026 real estate market? It's a year of rebalancing. Stability is replacing the chaos of the last few years. Whether you're buying or selling, the key is strategy and patience. Stay tuned as we continue to track these shifts throughout the spring season. This has been your 2026 Real Estate Deep Dive. Thanks for watching. As we move deeper into 2026, one question dominates every conversation. When will the market finally break? The tension between buyer hope and economic reality has reached a boiling point. We've seen the interest rate shifts, but the core issue remains. That brings us to home prices, and I'll be blunt. Don't expect a fire sale. The data suggests prices will continue their slow, upward creep in 2026. It's a sign of a market that's found a floor, not one that's collapsing. For buyers hoping for a crash, this stability is actually a tough pill to swallow. It means the dream of a bargain is fading, replaced by a slow, steady grind. But why is this happening despite the pressure? The primary driver is inventory, or rather the lack of it. Homeowners who locked in low rates years ago are staying put. This golden handcuff effect means the supply side remains constrained, preventing the massive sell-off needed for a price drop. Meanwhile, demand remains remarkably resilient. A new generation of buyers is entering their prime home buying years. They aren't looking for a bargain anymore. They're just looking for a way in. This competition keeps the floor solid. Of course, it's not uniform. While the national average creeps up, specific regions are seeing more volatility than others. The pandemic-era darlings, the overheated markets, are the only places where we see actual cooling. But even there, it's a correction, not a crash. The broader economic backdrop of 2026 supports this. Employment remains steady, and wage growth is finally catching up to inflation. So what's the strategy for a buyer in this slow grind market? It starts with resetting your expectations. Stop trying to time the bottom. In a market that's found its floor, time in the market is more valuable than timing the market. Focus on the intrinsic value of the property and your long-term holding capacity. Equity is built through years, not luck. For sellers, the paradox is equally real. You have equity, but where do you go? This lock-in is the invisible wall of the market. Unless you're downsizing or relocating to a cheaper area, the cost of trading up has never been higher. This doesn't mean the market is broken. In many ways, it's healthier now than during the 2021 frenzy. It's just slower. The grind is the new normal. It requires more discipline, better financing, and a much longer horizon. If you're waiting for 2008 to repeat itself, you might be waiting for a train that isn't on the tracks. 2026 is about stability. Accepting the floor is the first step toward making a smart move. The bargain is gone, but the opportunity remains. In the next section, we'll look at how this price paradox is fueling a revolution in the rental market. I'm Elizabeth. Thanks for watching. The real estate market is in a peculiar state of suspended animation. To understand where we're headed, we have to look past the surface-level headlines. While inventory is starting to recover from record lows, the actual movement in the market tells a much more complicated story. This stagnation is most visible in the sales volume. Even with rates dipping a bit, the number of people actually closing on homes is still way below the historical average. We're seeing a standoff. Sellers refuse to budge on price, and buyers refuse to pay peak prices plus today's interest. So, who's going to blink first? The answer, as always, depends entirely on where you're standing. You have to look at the map, not just the national news. In the Midwest and parts of the South, smaller metros are seeing a real shift toward affordability. But in the major coastal hubs, it's still a high-stakes game that's squeezing out the middle class. The national average is a lie. The truth is in the local data. You cannot make a financial decision based on a single number that averages 1,000 different markets. When you dive into the specifics, you see that supply-demand dynamics in Austin look nothing like those in Nashville or Seattle. The key to navigating this standoff isn't waiting for a national crash. It's identifying the pockets of opportunity where the scale is finally starting to tip. Stick with us as we break down the top 5 metros where buyers are actually winning right now. The real estate market of 2026 is defined by one word: resilience. While many waited for a crash, the reality shifted. Inventory remained at historic lows, keeping prices stable despite higher interest rates and economic uncertainty. For millions of aspiring homeowners, the waiting game became a costly strategy as equity growth passed them by. New supply couldn't keep up with demand, creating a floor that prevented the 20% drop many had predicted. This led to a surge in the rental sector, as those priced out of buying were forced to stay in the tenant pool longer. To understand how this played out on the ground, we need to look at the winners and losers of this new reality. Let's look at two hypothetical but very real scenarios for 2026. First, meet Sarah and Tom. They're first-time buyers in Austin, Texas, waiting for prices to drop 20% before they jump in. Based on the data we just covered, that drop isn't coming. They're stuck in a cycle of waiting, losing out on building equity and paying rising rents in the meantime. Now let's look at the other side. Meet Marcus. He's an investor in Cleveland, Ohio. He sees the frozen sales volume not as a problem, but as an opportunity. Fewer people can buy, which means more people need to rent. He buys a modest duplex at a stable price, locks in a 5.8% rate, and rents out both units. His cash flow is positive from day one. He's building wealth while others are sitting on the sidelines. Sarah and Tom are waiting for a boom that won't come. Marcus is profiting from the new reality. The lesson? In 2026, the market rewards those who adapt to the data, not those who wait for the past. Location matters, but strategy matters more. Austin's hype created a barrier, while Cleveland's stability created a door. Equity isn't something you wait for, it's something you build through action, even in a frozen market. By providing housing in a high-demand rental market, Marcus secured his financial future. If you're looking to enter the market in 2026, stop looking for the crash and start looking for the cash flow. Stability is the new boom. The numbers don't lie, and they're pointing toward a more balanced, long-term approach. Don't get left behind like Sarah and Tom. Be the Marcus of your own real estate story. The market is moving, are you?
So, what does this mean if you're looking to invest or build long-term wealth? This slow market can actually be a friend to the patient investor. Here are 3 strategies to apply right now. Drill down into zip code level data. Look for areas with job growth that haven't yet seen prices skyrocket. That's your pocket of opportunity. Analyzing local trends is the key to finding value where others only see averages. With fewer wild price swings, you can focus on the income a property generates. Renting becomes a more attractive option for people who can't buy, which means demand for well-priced rental properties could increase. It's about playing the long game, not looking for a quick score. Sustainable wealth isn't built overnight, it's harvested month by month. When the right opportunity appears, whether it's a motivated seller or a slight dip in rates, you need to move fast. Being pre-approved gives you the power to act decisively. Preparation is the bridge between seeing an opportunity and owning it. Don't wait for the market to move. Be ready when it does. Invest in your knowledge, stay patient, and stick to the 2026 playbook. Your future self will thank you. Welcome to our 2026 Real Estate Deep Dive. As we look ahead, the landscape is shifting in ways we haven't seen in years. After a period of stagnation, the market is beginning a slow, deliberate thaw, revealing new opportunities. Interest rates have settled into a new normal, allowing both buyers and sellers to plan with more certainty. Inventory is finally catching up with demand, but it's not a uniform recovery across the country. Success in 2026 depends heavily on sharp local knowledge. What works in Austin might not work in Miami. Buyers are becoming more discerning, prioritizing long-term value over quick appreciation. For sellers, pricing strategy and home presentation are more critical than ever in this balanced market. Technology continues to reshape the search process, with AI-driven valuations becoming the industry standard. New construction is filling the gap, focusing on sustainable and energy-efficient designs for the next generation. Institutional investors are pivoting toward mid-sized markets, seeking stable yields and community growth. Global economic shifts are also playing a role as international capital seeks safety in U.S. residential assets. While opportunities abound, risk management remains paramount. It's a market for the patient investor. The luxury segment is also seeing a resurgence, driven by a flight to quality and unique architectural heritage. In the rental market, amenities and lifestyle-centric developments are outperforming traditional housing units. The resilience of local economies is now the primary indicator of long-term real estate stability.
Looking toward 2027, we expect this stability to continue, rewarding those who prepare today. Doing your homework now is the best investment you can make for the road ahead. So, what is the ultimate takeaway for the current landscape? Let's wrap things up. The bottom line for 2026? This isn't a boom and it's not a bust. It's a market that's slowly thawing, creating pockets of opportunity for those who do their homework. The days of easy money are gone, replaced by an environment that rewards patience, sharp local knowledge, and a clear plan. Don't wait for the perfect moment. Prepare for the right one. If you found this video helpful, please like, share, and subscribe. Thank you for watching.